part of what we'll do is kind of introduce you to everyone, and you can provide your contact information when they have deals if they want to take a look at. And they don't have to go through me. They don't have to go through Acquira. They can just reach out to you directly so that, again, you can kind of build those relationships from that standpoint. But it's good to see you again.
Likewise. It was great. Thank you for giving me a direct contact with the group. I think, you were really just condensing some amazing knowledge where, smart people learn from their mistakes. Wise people learn from mistakes of others, right? So there's no reason to have to make the same mistakes, right? We can always learn the easiest way through each other and through the community. And unfortunately, there's a lot of little steps that we could all learn, and there's a lot of there's a lot of mistakes to be made and avoided, right?
For sure. Yeah. So I typically will, we would normally wait 3, 4, or 5 minutes because people will be coming in a little bit later here and there, but I don't want to hold you up, and I figured we can kind of jump in and get started. And it's more or less the way I probably prefer to structure this with you. You're a dynamic speaker, but I don't want everything to fall onto you to kind of push this meeting forward. So I figured we just kind of set it up more as a kind of an interview. I'll ask you some questions, and you can expound upon those questions or some answers to those questions. And then we can kind of let the discussion go from wherever, and we'll allow the AEs to kind of jump in and ask questions as needed as well. Sound good to you?
I love it. Let's go.
All right. So welcome, everyone. Most of you guys probably have at least heard of me, seen me in videos. If I haven't talked to you directly, there's a bunch of you I've never met that have come into the program just recently. I'm sure right now we have about 15, 16 people on. We'll probably end up, from the responses that we have, probably with about 20, 25, 30 people that'll come in at some point. But I just want to introduce myself for those who don't know me. My name is Rich Coppage. I'm the Director of Transaction Advisory Services for Acquira. What that means is if any of you are looking for due diligence help, financial modeling help, basically helping you close on the deal, taking you from post LOI through the due diligence phase and kind of quarterbacking that process. That's what we do within Transaction Advisory Services. I've been here for now 5 years, which makes me, I'm always proud about this fact, which makes me the longest tenured member of the Acquira team outside of our founder. So I've seen this firm kind of morph over the years. I've had different responsibilities within the firm, but the funny thing about that is from the time that I started to where I am now, I'm basically doing what they hired me to do when I started, which is a good thing. So I've seen a lot, talked to a lot of professionals. I'm a former investment banker with Merrill Lynch and Morgan Stanley, so I have some transaction experience from that side. And I own up until recently, I owned the majority share of a manufacturing company that I bought 2 years ago, and basically sold down my majority position to my partner from that standpoint. So I have made small business acquisitions as well. So I can pretty much answer questions that run the gamut, but I am not an SBA lender, which is why I wanted Javier on this call. SBA lending is there's an expertise that's required to understand the nuance of it, the SOPs that change, and I wanted to have Javier on to introduce himself and Locality Bank and what they do to you guys as one of our lead vendors in terms of providing SBA acquisition loans. And so with that being said, Javier, welcome to the call.
Thank you, Rich. I love the extensive experience, the going, AE was a part of a small business that's growing right now, 5 years and expanding. I can see the scale that you're at now. So it's impressive. And, I like to say I'm a one-trick pony. I think it's a good trick, SBA lending. I've been doing that now for over a decade, primarily starting shops from scratch. I've done it 3 times now. This is my third go around, and guess what? I got a little bit of ownership in this bank. So
There you
this is the
go.
one I hopefully get to ride for the long run, right? Learning from the experiences is better being an owner than an employee, right? That's
Yeah.
good for the group. And frankly, I think this product, it has amazing advantages in the small business lending, space, but from a use of proceed perspective, there's no better use than business acquisitions. Like you can find a better conventional product for every other use except for BizAc. BizAc, SBA really in the banking space, there's no alternative, right? The LTVs of 90% with structures that you can get created to 95, right? LTVs, 10-year terms. If you're buying a business at let's say 3 to 4.5 times owner's benefit,
Hmm.
you're paying on a 10-year money, but you're buying for 3.5 to 4. So that means at the gate, you should be at least cash flow positive. So you as a business owner, as a new owner, your main responsibility should be, how do I maintain the business operations, right? We cannot go backwards. And then you can master and then grow and gather more efficiencies and expand, right? Because the whole idea here is to improve a lot of these businesses that frankly have a lot of low-hanging fruit that has not been tapped into. Um, I also just got back from Colorado Springs last week. It was nice. A little Cuban guy hanging out in the mountains over there. It was a little cold. It got down into the 20s, a little cold for my blood. But it was the National Association of Government Guaranteed Lenders, NAGLE, annual conference. And that's where myself and all of our small business SBA lenders hang out once a year. So we rotated. This year was in Colorado Springs. It was an interesting session this year because normally we are visited by our good friends from the administration, right?
Uh-huh.
But I don't know if anyone on this call has been paying attention, but there's a little bit of a shutdown going from the government side. So we weren't able to have our good friends from the SBA come and chat with us, and we rub elbows and poke around about what policy changes we would love to see, or where the lenders didn't do so well, right?
Yeah.
It's an interesting community, right? So small business lending, you really look at it, there's about 1,000 lenders in the country, right? And that's a fragment. There's about 5,000 banks and 4,000 credit unions,
Hmm.
and there's only 14 non-bank SBA licenses, or SBLCs is what they call them. That's the acronym.
Yeah.
Another little interesting statistic, though, is, and that's mostly the 80-20 rule, but a little more concentrated. But the top 10 SBA lenders really do about 80% of the volume in the country. So those are like pump and dump, but those are like standardized.
Yeah.
Where you get the true sweet spot for like professional SBA shops that aren't, that are doing good volume, but aren't pumping out $1 billion a year, right? You're really talking about the bespoke, you need to work a deal. And there's two categories of deals that really fall into this bucket. There's some shops that do, like, they're real estate focused, because real estate is a whole art on top of SBA, right? So
Yeah.
you got to have that expertise, you got to know the area, there's a lot of things that go involved in that. But business acquisition is the second one, right? Because the SBA has the rules, and then you have a whole another section about business acquisition that is a subset of that SOP. And luckily for me, because that gives me job insurance, these are the most actively changed policies in the SBA, right? It's 10% 1 year, and then maybe we can do 2.5% if it's on standby for 2 years, right?
Yeah.
It gives me job security. But I enjoy what I do, because I get to work with entrepreneurs, and frankly, if you're having a bad day, all you have to do is hang out with some entrepreneurs, and you're going to be feeling like $1 million at the end of the day, because
Oh,
there's
yeah.
no much energy, optimism, self-starter, growth mindset, right? Like all the boxes. And selfishly, I think it's why this country is the greatest country in the world, right? It's built on the back of people who are willing to take risk and to create something, and pursue. The pursuit of happiness isn't just self-indulgence. The pursuit of happiness is self-fulfillment, of actualization, and supporting our society, right? So we're lucky to play a small part of it. Access to capital is I think the SBDC down here in Florida did a survey last year, and asked small businesses, what do they want, right? And The number one thing is, guess what? Revenue, right? So
Mhm.
everyone wants more revenue. Surprise, surprise. But the second item is access to capital.
Yep.
And, it's the getting the resources you need to take advantage of opportunities,
Yep.
right? So I'm happy, our approach at Locality Bank, which is, a small community bank headquartered in South Florida. We just got out of our startup period. We were founded in 2021, and it's a 3-year de novo. This is what it's called when you have a startup bank. And
Mhm.
now we are able to go nationwide. Right, our primary preference would be the Southeast United States from a geographic perspective, but either directly or in participation, we work across the entire country. And if for some reason we can't get along, I'm happy to introduce you to one of my other 999 lender buddies at the trade association. But Rich, I don't know like what angle we want to go down. I'm happy to go into the program history, or if we want to talk about current events, or talk about
Yeah.
deal mechanics.
Yeah, I think we'll go. We'll definitely. I want to go in towards your bank's appetite for deals, what types of deals you like, and then maybe some of the kind of deal mechanics as far as structuring deals that will kind of be SBA compliant. I think that's always a hot topic from AEs, and we'll kind of let the AEs kind of chime in as well and ask individual questions. But let's start with. So basically, what's going on in the marketplace with the whole government kind of shutdown? How's that affecting lending right now as far as getting loans out the door from your bank? First of all, you guys are a preferred SBA lender, correct?
Yes. So let's talk about what's the difference, right? You have two
Yeah.
types of SBA processing. The first question you should ask every bank: do you do SBA loans? Second question: are you a preferred lender? Which is, see, Rich knows his stuff. So what does that mean? That means if you're just a general processor, a GP lender, when you approve a loan, you still have to follow all the same SBA rules, gather the same SBA documents, do this whole package. But then you have to send that to the SBA, and they have an office in Sacramento and another one, I forget what city in Kentucky, but there are people that act as a loan officer on behalf of the government and review the file, and then they approve it. So it adds about 2 to 3 weeks normally, but given the let's just say, well, the current status of the government, nothing's happening there. But let's just say with the reductions in force, SBA has significantly reduced credit officers, right, to do this function. So furthermore, we're now, if you're a PLP lender, you're no longer allowed to send a GP. It used to be discretionary, where if a bank felt that there's some gray, because there's a lot of gray, even though there's 350 pages of SOP, there's a lot of gray. Now we as an institution aren't allowed to do that. So, which is great for as an in lender inside the institution. I love that, because then my chief credit officer and I are like, hey, you can't go GP anymore, man. We got to go PLP, pull that number, let's go. So now you're PLP, same approval process, same package, so information is the same, except for when we approve the loan, it's already approved by the SBA. We have delegated authority, right? So then all we need to do, we still have to interact with the government. They have this e-trans system, very clever naming, and you just do data entry, right? So I have someone in my staff that's literally plugging away, gathering the data from the documents, inputting it into the system. And what that system does is a few things. There is a secondary the K-verge or background check inside the government. So they're checking now for immigration status, right? Because now SBA needs to be 100% U.S. citizen or legal permanent resident, which that was the new rule that came this year under the new administration's SBA policy. There is some rumors that could change, right? But this is very preliminary. These are the whispers in Colorado Springs, right? Everyone talking inside whispers about what the internal policies are, and we can save those nuggets for the end. But the SBA today, really, delegated or not, I can't submit that number.
Okay.
So if you did not get an authorization number, that's or an approval number is what some banks call it. You're not going to be able to close the loan, because there's no one on the SBA side since the shutdown that will spit back that number. It's like a policy number. That's the guarantee that the bank puts away in their file in the event of a default. Okay. So what does it mean? Am I on vacation? I am not, Rich, right? We're still working, right? So I had a loan that we did pull the authorization for. It was actually a business acquisition of a auto body shop down here in South Florida for $2 million with a $200,000 seller note and a $200,000 equity injection. And this we were very lucky because we knew it was coming, right? Everyone knew when the government shut down. We approved it. And the day after we pulled the off, like bam, boom, get it ready to go. And we were working through the closing process. We have several other loans. I have another business acquisition loan that I'm working on as we speak. Hopefully the approval will come tomorrow or Wednesday. And this is a specialty manufacturer who does some nozzles, very high-end manufacturing nozzles for high-end manufacturing processes. They're one of my favorite examples is they have one that puts the sesame seeds on top of the sesame seed buns for Burger King. So like shooting it onto the buns. Can you imagine the precision of that? It's amazing.
Wow.
Great little company, doing very well, and we're working on. I think it's a $3.5 million purchase price, and we're working. What's cool about this one is there's some disagreement on the valuation. The valuation came in lower, so we had to have the adult conversation about the gaps, right? So where we ended here was a combination of reduction in price, which everyone was happy, but then the seller still wanted a little more. It's like there's more value here, and the buyer felt that it was merited, right? So what did we do? We did the rebate seller note structure, right? You can't do earnouts, but you can do a forgivable note, right? So they built a beautiful conditions inside the note where it was tied to revenue and its CAGR, so it's compounded annual growth rate. Yeah. And if it did not hit those minimum requirements, which if it did, it would justify that increase.
Yeah.
But if it didn't, boom, you wipe out that principal balance note, and now you're closer, albeit not fully, but you're closer to what the quote unquote BV was when we ordered it, right? So it was that's where the creativity happens, right? This isn't cookie cutter stuff. This is like, hey, brass tacks, dust is settled. What do we need to do? How do we negotiate? So we pride ourselves in as an institution to be flexible, right? We're trying to be solutions oriented, right? And the team, what gets me excited about one of the reasons why I joined the institution is that fundamentally the experience of the group is, I think we have an aggregate 60 years of experience, and I'm not even the most experienced of the team. So that really gives a lot of confidence in figuring out like this is as much art. Oh, let's see.
Yeah, Randy probably.
Okay, sorry, got distracted. I heard I'm like a rabbit here or a squirrel. But does that answer your question, Rich? I mean, like, hopefully we're all rooting for the government to open up their doors next week and we can start closing these loans. I just saw a statistic from one of my peers in the industry. There's 320 businesses, 170 businesses that didn't access $322 million of SBA financing. These are loans pending approval that haven't been done, right? So think about all that economic activity that's being unrealized.
Yeah. So
it's a sad,
So basically, everything that you got a pre-approval for before the government shutdown was able to be processed, but anything since then that were post-government shutdown is more or less just in a holding pattern at this point. Is that kind of what's going on?
Yes, that's a fair statement. But what we do, we can do everything but pull the off, right? So we can get the loan approved, we can get the closing package prepped, we can draw up the docs, right? Yeah. So a lot can be done. We're still working. It's just we cannot don't ask a bank to set a closing date because it's just
out there.
They're gonna be it's not gonna happen.
Gotcha.
Randy, really quick on the fees. I can answer the quick question. And then this is it is going to be frustrating, but the right answer that the lenders should always say, if a lender's worth their weight in salt, is the answer to all questions is it depends. Okay, so
just
the answer is exactly. So I've had this conversation already with a few other AE recipients. And so the answer is like if you're 100% of your equity injections coming from third-party fees, bank's going to be a little bit concerned, right? So if it represents the majority of the percentage of the equity injection consideration, then I would say, that's probably at my institution going to be frowned upon. But if it's you know, a quarter or less of the total equity injection requirement, and then we're talking about a combination of like maybe quality earnings. I want to make sure the quality earnings are good, right? That's a whole different service. And then you have the setup fees or the consulting fees. But there's the ineligible items that the SBA won't allow, right? So those can't happen. And then everything else, we just, as an institution, we want the majority of the equity injection to go into the business piece, right? So that's kind of where we fall. I know that doesn't give you a clear yes or no question answer, but I'm being honest. I'm being honest.
It depends. Hey, so the other part of his question was around, and I know we talked about this in Florida, was the issue with like AEs buying, businesses that require a license, like these trades businesses, where the AE is coming in that doesn't have the license. And, it used to be in the past, lenders would look, as long as you've got there's a good transition plan and you can explain what that transition plan looks like, and it looks like it's doable and likely to happen. Lenders were happy with that. Some lenders have gotten a lot more strict with, no, there needs to be you need to have one to buy the business. Some of that's an extreme position, but some of them are like, no, but if the seller is leaving the business, or if the seller's leaving the business, but there's someone there that has a license, then we want them to have equity in the business. So kind of explain your bank's reasoning or position on this issue, and kind of like your reasoning behind it.
Yeah. So I'm going to give you one guess of what my answer is.
It depends.
It depends. That's right. Man, Rich, you're paying attention. So if you're coming to me and you're wanting to buy a biopharma tech, company, I'm going to want to see some direct experience, right? It's just, that's, there's the, degrees of sophistication here, right? If you're going to buy a pest control company, I used to be in pest control. I was a licensed pest control person before, that was a long story, right? And I would prefer to have that conversation over beers. But, the qualification requirements to get a pest control license, not the same as biopharma, right? So in the industry that you're going, services industries are probably closer to the pest control than the biopharma side. Some could be a little bit more, like on the construction side, you have to have a very good plan. But you talked about, the beautiful thing is there are other people that you can hire to have a license, and that's a market that exists. And this is where you have the opportunity to, do some research, present it in your business plan, right? Your succession planning and your strategy. Plan A, I want to get the license. Plan B, I have a very good agreement with the current license holder. I don't know, contract, I don't know, profit sharing. Like there's a lot of things that you can do to inherit the person. And then option C is, what's a marketplace right now for an existing license holder that you can bring on, right? This is recruiter quote. This is an Indeed listing, for an existing provider, right? So these are ways that you can help me mitigate that issue, right? And that allows, because look, bankers, we're not specialists, guys. We're not good at any one thing. We know a little bit about a lot of different things. So what we look for, and we always default with like the worst case scenario. That's like, you've talked to my chief credit people or my chief credit officer or my credit people. It's like, what is the worst thing that can happen? That's the first thing they point out. Like, oh my God, what's going to happen if this guy gets run over by a truck, right? So it's like, always like, what's the worst thing that can happen, right? Tsunami hits, what do we do? Like, it's just, they're not the most optimistic people, but that's okay. That's your risk mitigators, right? That's what we need. We need the people to keep everyone else in check. So that, and hopefully that kind of gives a little more clarity, but really, is the plan viable? What are the steps? Have more than one option, right? Plan A, plan B, plan C. Because ultimately we are partners in this transaction. We want you to succeed because that's the only way you can pay us back.
Yeah.
So that really, we're not equity partners, we're debt partners. Yeah.
So it's kind of like, kind of on the back end of that, in general, kind of how do you evaluate, like, if an AE were to come to you, how do you evaluate their kind of their experience? Are you guys more interested in kind of industry specific experience, or can transferable like management experience kind of suffice? Kind of how do you see, or how do you evaluate the actual buyer of the business from that perspective?
Well, both are important, right? And the conversation we were just having really focuses on the what. So there's two main business activities, right? You've got your core activity, like what do you do to make money? What's the service or good that you're producing that generates revenue? Then you have all the supplementary activities, right? The supplementary value propositions, which are the management, the marketing, the sales, the HR, the legal, which is a whole, like, that has nothing. You make bread, you bake bread every day, you make the best focaccia on the planet, but that has nothing to do with accounting, right?
Yeah,
So,
exactly.
but the guy that is next door to you who has all their supplementary stuff in line, but maybe their focaccia is not as good. They might do better because they have cost controls and they're not missing their licenses, and the IRS isn't breathing down their neck, or they didn't realize that all their labor costs went through the roof. So these are, like, unfortunately, the burden of the entrepreneur, where you have multiple hats, right?
Mhm.
But the good news is this is where you can really take in your experience from your other previous careers or backgrounds, right? So we love to talk about if you have military service and working with a group of people, you have projects or operational success. How did you manage, right? Because maybe you don't know how to bake bread, but you can learn, right? And you
Mhm.
have a good team of bakers, but then you have all this background experience in the financial components or legal or marketing, right? And the combination of the two is what really is your business model and strategy for implementation.
Got it. Yeah. So it really is dependent upon, like, kind of almost like when you're evaluating the business and the pain points of the business and how you can solve those. If your skill set is relatable to that pain point, that's a lot more important than a skill that may not be necessary in that business, from an evaluation standpoint. So effectively, let's say you have a business with a sales problem and you have sales experience in another industry, that's looked on more favorably than, someone who's an accountant that comes in and try to buy the same business, but he doesn't have any sales experience from that standpoint. Okay, that makes a lot of sense.
Correct, Nick. Like managing the P&L.
Yep,
Exactly.
yep.
That's part of the business.
So let's one thing that I think we miss a lot on these SBA loans. Everyone wants to be qualified for them. Hey, I got this deal. It looks great. You're willing to lend me 80% of the value of this deal. I put in 10%. The seller puts in a 10% note, and then all of a sudden they get and usually this happens kind of midway through the post LOI due diligence phase. But all of a sudden you get a call from your banker that says, "Hey, what cash reserves do you have for post closing liquidity?" And then all of a sudden we have AE scrambling, like, well, now I got to go try to raise some more money from friends and family because I won't have enough beyond that. Maybe kind of explain what post closing liquidity is to the group, because I think a lot of them may not understand it, and then kind of how I guess Locality looks at it, what that calculation might look like, because that is a reserve that's, it can be a big number, and these AEs need to really plan for that. So can you kind of talk about that a little bit?
Yes, and that is like a very long conversation, which is a very nuanced one. And the reason why is because it depends on the type of business that you're buying, right? Your cash conversion cycle is really what's going to be driving this bank view, right? So what is the cash conversion cycle? That is your AR days plus your inventory days minus your AP days, right? And what that is what's your minimum amount of money that you need to keep in the business just to maintain the top of funnel activity, right? So in order to provide that good or service, those are the days you need to hold. Let's just call it, let's say it's a 60 days calculation. Whatever your revenue for the year is, divide that by 365 and you hold 60 days. You need to at least have that in cash in order to be able to buy the widget or hold the AR by the time you get paid in order to cover all your other expenses. That's
Mhm.
layer number one. But it's the most important because that if that machine is working efficiently, then that should cover your OpEx,
Mhm.
right? Because we're talking about gross profit layer,
Yep.
right?
Yep. Yep.
Right. So then all your OpEx, as long as it's maintained or decreased, then you should be in free cash flow land, which is where we all want to be in, right? So what, unfortunately, before me at this institution, there was a business acquisition transaction where it was a very, it was I think a $4 million purchase, and the seller took all the cash out of the business, and there was no working capital lent into the business, and the all the equity injection from the buyer was used. I mean, all their cash was used for the equity injection.
Yep.
So they are bone dry, and their cash conversion cycle is pretty long. So tons of revenue potential, contract sign, good clients, but they're barely hanging on, begging and borrowing because they have no liquidity in their conversion component, right? So they can't keep that top, like they're behind with their vendors, they're stretching out the loan payments. That is not where you want to be. So when you're the key here, Rich, is you're looking at the whole project,
Yep.
right? So the purchase price is X, but what's inside the purchase price, and do we need to add something to it, right? Because you know we're always focused on get the best price, right? But is that really all you need for the business, right? Do you need a purchase price, maybe additional working capital because the cash was pulled out, right? Maybe
Mhm.
you need some additional monies for equipment or some renovation on the property, right? So this is time where you can review those components, and frankly, that could be a negotiating tactic, right? So
Right.
that you can probably get a sweeter deal, and then you fix the problems as long as you make a good case on the back end with a larger note, but for other uses, right? Because that can do 90% of the biz act, and because it's technically a startup, you're forming a new entity, you can do 90% financing on any other use that they have.
Yeah.
Okay.
So yeah, when I look at these things, when I'm analyzing these things with an AE, one of my I would say, and this is basically my own personal philosophy, is that and I've explained it. I've talked to this to death over the years I've been here, and and I get into disagreements with some people about it. But my whole point is like, look, if I'm paying you a multiple of EBITDA or what a SDE, within that number, that's that historical number, there's some level of normalized working capital that has helped generate this business. And if I'm going to pay you a multiple on that, then I expect that normalized working capital number to be left in the business at the end, once we close on this deal, because otherwise, I have to borrow that money from someplace, or I have to get an investor to bring in that money from someplace. Or the other way that I can solve for this is just to drop my price by that amount of money that I'm going to need. And so I get into these discussions with AEs, and they go, well, they want us cash free, debt free, and all this stuff. I'm like, that's great, but let's just kind of calculate what that number needs to be first before we agree to that. And we can agree
Do
to
you
it,
hear
but
that? Do you hear that, Rich?
yeah,
Those are all the bankers in the country clapping at once. They love that. That is 100.
yeah,
But it's one of the most critical. It's the most difficult conversation because everyone's like, "Oh yeah, I just take what's in the bank account, right?" Or even I've even heard of like, I'll do some collections of these clients of the jobs that I did. Like, well, like, so what is the business going to live off of? Like, how are they going to
exactly.
run payroll next month, right?
Yep.
It's just there that it also is in line with like when I get, oh, the equipment is worth more than what I have on the balance sheet.
Who cares?
Yeah, it's like that has no impact on the like free cash flow. Right? The equipment
Yep.
is used to make it, but the
Yep.
value of the equipment doesn't have the impact me whatsoever on the operations, right?
Exactly.
Um, yeah, it's very nuanced. And Sean, I want to answer your question. This is another like concept. So the answer is it depends. So you answered it yourself. But frankly, it's about, do you want to put your best foot forward to the lender, or do you want to minimize your risk but also make it a worse or the more difficult approval process, right? So if you're getting the HELOC, here, I'm going to take off my banker hat. I'm going to stop selling. I'm going to say, I think HELOC rates are lower than SBA rates by a mile, right? And if you're going to ask for working capital in an SBA loan and you have a HELOC availability and you're willing, like if the SBA is going to encumber that property, maybe it's a smart idea to put the HELOC on there. But here, to tie everything together, my bank wants to keep a $500,000 or less unexposed guarantee exposure, right? So net of guarantee and net of collateral, I want to be under $500,000. So if you're encumbering your home with a HELOC, that means I don't have availability to it. That means that your unsecured portion is larger, and depending on the size of the deal, that could be the difference between a yes and a no. For me, right? So the answer is it depends. It depends. So if you have, for me, number 1A and number 1AD are cash flow and character. Those are the two most important things, right? Because ability to repay, like collateral doesn't pay loans, cash flow does, right? So that's what I care about. B, character, because that's I don't care how much of a guarantee you have, you can't mitigate character with an insurance policy.
Mm-hmm.
You're either someone who's going to take it seriously and do the right thing, or you're not, unfortunately, right? So, and then the distant third is collateral, because that's what the government guarantees for. But it does impact credit attractiveness to the institution.
Yeah. Got that.
Javier, can I ask a question real quick?
Go ahead.
Is there an upper limit to how much a seller can carry as a percent of the deal?
No upper limits. We will be scratching their heads if it becomes like, the same size of our loan. But I've seen, believe it or not, I've been in conversation. This one didn't get, that would have been a fun party. It was like a $10 million acquisition, $5 million is the cap on SBA, and the seller was willing to hold, I think, another $3-4 million. But the buyer wasn't able to get all the equity for the remaining gap, or something happened in due diligence, I forget. But there isn't a limit. It depends. It becomes a problem if the debt service of the larger seller note becomes detrimental to your overall debt service, right? Because our approval processes include any other debt that is being, included in the transaction. So you need to be at 115 minimum. But your banks are going to want to see you at 1.2, 1.25 times or higher if they want to feel good, especially in this very interesting economy we are in today.
Okay, I was thinking more in the case of exactly that reason, to maintain a usable or acceptable debt service ratio. If they are in a second position, they said, hey, I'll carry more debt with a forgivable note based on performance metrics over the long haul. How would that look on an application as you're going through that deal? Say, hey, we have a lot of confidence in this business. We'll carry a little bit of risk to make sure that it's performing over time. And it gives you, an initial 2-year, 3-year period so that you can get your feet underneath you and grow the business and say, okay, now we've achieved the metrics to be able to service both the debt service ratio, or both the debts.
Well, and before
Aaron,
you answer that, Javier, before you answer that, let me throw another wrench in there to add to Aaron's question. So you've got the seller note, you've got a portion of it that's forgivable, and that you'd have to know what that percentage looks like. But then the other question, or the other issue I would throw in, how does the bank look at the seller note if you manage to get a deferral on principal and interest over 3, 4, 5 years to go with that? Does that count as does that portion of the note now not feed into the debts, not so much the debt service coverage ratio, but the debt ratio, meaning like, your overall leverage? Does that number come down?
Yeah. So part A, right? We love when the seller takes paper. Love, right? Because a big risk on the outbound is the seller, right? How much legacy knowledge? How are they going to interact with the business? And the more skin in the game that the seller has, the more aligned the incentives are, right?
Mm-hmm.
So love that, right? And then now you're talking about full standby structures. So can accrue interest, but no principal or interest payments can be made. If you want that to be an equity injection piece, it has to be for the full life of the loan. And in those cases, I don't even think about it.
Mm-hmm.
If it's on full standby and subordinated, that's your problem. After the loan is paid off, that's when you have to deal with it, not me.
Yep.
right? So that's something to consider. Now, if you do a 2, 3, 4, 5 year standby, then it becomes a bank decision.
Mhm.
When
Okay.
does the bank want to consider and hit you with those debt service payments? What are the projected revenues in the next 2 years, right? If this is a industry that has very low growth rate expectations, and yet in year 3 debt service is going to triple, I'm doing you a disservice because you're now walking into a problem that you're not going to have a solution for.
Exactly. Yeah,
You know,
that makes sense. That makes sense. What
Thank
what's the like kind of what's your minimal debt service coverage ratio looking you look at?
115 is the SBA minimum requirement.
But what's your
And
ideal? What's Locality's
well,
ideal? Where they want
it depends. I want the highest one possible, right? But the reality is, if you have a 115 at the business level, but you have a 115 at the global level, then that's interesting. Well, if I'm, have very little collateral, uncollateralized exposure, then that's a different conversation, right? If you have a significant liquidity base, you can have a little bit of bumpiness, and you have the cash to pay. But if you got no cash, no collateral, and it's a cash intensive business, that debt service is going to be a very tough thing to pill to swallow. Like trucking, it's going to be tough to do trucking, guys. I mean, it's that just all those things I just checked off. That's a trucking company.
Yeah.
High capital intense, labor intense. There's a reason why they've been having issues.
Larry,
Yes,
what's
Larry.
up?
Yeah. Hey, I'm right now put an LOI on for a construction business, and as part of it, the evaluation, it looks like they have contracts out to 2029 for a good, so large contracts. So how would that, in terms of like then what you were saying about this, the standby, having seller's note for like 2, 3, 4 years, how would
Tied
that
to the
impact the
completion of that
thoughts on it?
contract is what you're thinking,
Yeah.
Larry?
Yeah.
That's smart. That's smart because then you can tie the repayment of that note to the contract parameters. That should be pretty straightforward. I mean, you should be paying a multiple on the revenue cash stream of that contract if that's the differential. Because I think what you're saying is that they want you to pay the current value plus future revenues of contract signed in hand. Is that correct?
How are we looking at? Rich is actually helping me evaluate this thing. We decided we're paying a higher multiple on the EBITDA, and then they're saying and then they've revealed that they actually have these contracts going out to 2029, but
Yeah.
haven't.
So what
Setting.
what we've done is looked at the kind of the historical nature of the business, kind of like, because this is a construction management services firm.
Yeah.
And so they work on very high-end commercial developments that are specific to a niche. And their end customers are businesses. They're not developers or anything like that. So what we looked at was its historical numbers, but then my thinking and Larry's thinking is, well, let's just make sure that what we're paying for, we're actually getting. Because typically with a construction company, trying to pay on their historical numbers doesn't always make sense if their pipeline, their WIP, and their backlog isn't equating to what that historical number is. Because you're not really, if you're paying for past history with these types of companies, you could end up getting burnt. Because if they don't have anything going on, then what did you really pay for? So what we're trying to do is, part of our offer was, look, we're willing to pay you based on kind of how you're currently doing, but we also want some sort of a guarantee that when we get to the close, that we have enough in the WIP and in the backlog that justifies the price that we're paying. And so then I think we're trying to really tie our payments, or trying to tie that value to kind of that current WIP and backlog, as opposed to just the historical number. So trying to structure a deal that makes sense from that standpoint, and that makes sense for the lender from that standpoint, is kind of what we're really trying to focus on at this point.
You're looking for a minimum net working capital base, right?
Yeah.
So, and then that could be a combination of WIP or AR, and your pro tip, discount it, right? Agree to a discount number, and then that's something that's going to be moving target until the week of close.
Yeah.
right? And because they're going to be doing business and new deals are coming off. But the calculation is you need to know your floor.
Yep.
Right? What's the minimum amount you want? And you would probably want to add a little cushion to that, right? On top of that. And then you want to discount any non-cash, net working capital components, right? So that way, do you expect to collect 100% of the receivables? I'm sure everyone wants to, but reality is there's probably a bad debt section, right? Or is all the WIP, is all that realized, or is there some, stuff that happens along the way? So
Yeah.
it's all about building cushions and layering in mitigants, right? And having multiple plans. But I love the idea of putting this up tied to performance. The earnout is it's the same function as an earnout, right? And just the education for everyone's sake, the reason why the SBA doesn't like the earnout is because we want to be able to concretely show what the purchase price is. On an earnout, you have an open-ended ceiling, right? Because the business does gangbusters, then the purchase price is actually more because they've earned out more. What's counterintuitive is if they went gangbuster, who cares? They earned it, right? That's why it's called an earnout, and that's good for everybody. But to the SBA, it's bad because we don't have a fixed number. On the seller note is we have the fixed number, but it could be less because if the performance doesn't go, then at least who cares if it's less? The government says that we've already seen what the worst case would be. If it's less, it's only a benefit for you as a business owner or the institution, and the indebtedness, right? So, don't ask me why, but that's just the way it is,
Yeah. Yeah. Let me ask you this question real quick. I've always been intrigued by this, or not even, I don't know if intrigued is the right word, but I'm just wondering, I guess, or bewildered. No, it's not even bewildered. But let me ask you this question. So the third-party business appraisal in the whole scheme of acquiring the business and you're working with your lender, like I've always, because I've read maybe a couple of pages of one and then I get bored and I don't want to read the rest of it. But what's the whole, like, I guess, process for the business appraisal? Like, how do they do those in terms of, like, are they using some sort of an asset-based approach? Are they using an income-based approach? Are they using some sort of historical multiple? Like, why would an appraisal come in from a lender standpoint any different than just kind of estimating what the historical numbers are from the tax returns and coming to some decision about cash flow, and how much debt can be supported on the business? And why would the appraisal be important in that process? Is it just more verification that, that's making sure that you guys have kind of dotted your I's and crossed your T's? Or is it really super, super important? I know if it comes in lower, then there's questions, but if their historical tax returns are showing what they need and you guys are using those anyway, I don't understand what the whole process or purpose of the business appraisal is.
All right. So the shortest way to answer that question is it's because it's in the SOP. The SOP requires us to get a BV, right? And the frustrating part is if you order 3 business valuations from 3 separate companies, you will get 3 separate values.
Yeah.
There's no such thing as consensus. There really isn't.
Hard.
So this is more of
science.
But it does what it does. It gives us a third set of eyes, right?
Yeah.
And the valuation methodology predominantly is focused on a net present value perspective of future cash flows, right? And that's based on historical performance. There is similarity to debt service coverage, but it's a different perspective, right? So it's what the business valuator should be doing is also, because my horizon is I'm looking at, even though I'm giving you a 10-year loan, I'm really looking at the next 3.5, 4 years, because the average life of an SBL in the country is that.
Yeah.
Right. So I'm looking over that horizon. When you're buying a business, you're married for life, right? This is you're married until death do us part or sell, right? Wish you could do that with your spouse, but it's business, right? You gotta deal with it. She's yours, he's yours, right? You gotta deal with it. So, ultimately, it's nuanced, right? The industry could be growing, so then the future potential cash flows are higher. The industry could be shrinking. There's incoming threats from replacements. There's a lot of that, and it's a canary in the coal mine, because what these business evaluators are, there's certain certifications that they need to have minimum in order to be a SBA eligible a business valuation company. And in order to maintain those certifications, you know, you can't get sued too many times, right?
Yeah.
So if someone sues you for like, hey, you said this was worth $5 million. This is definitely, it wasn't worth $10, right? So it's like, if you do too many big misses, then you as an evaluator are going to be in trouble. And your reputation's done and no one else is going to. So they always come in conservative, right? Or they come pretty freaking close to the purchase price, which is the magic. It's magic how that always happens, right?
Yeah,
But
exactly.
don't ask me about 2008 because that was a whole then there's a whole like real estate appraisal process that sprung up because of that.
Yeah, I remember that. So what speaking of real estate, what's the common question I get all the time is, should I buy the real estate with the business? And generally my answer is it depends. I use your answer for that. But if it's a go on the real estate, kind of maybe talk to the group about how the loan is structured in terms of the amortization. With
The
real estate.
magic.
Yeah.
Rich, you're talking about this is the like hidden magic inside SBA. So buying a business at 10 years, right? So you pay 4 and you use 10-year money and you get 4-year pricing, right? What if you can get more than 10-year money, right? So if real estate, the cool thing about SBA, if there's multiple uses of proceeds, you can do everything all at the same time. Working capital, business acquisition, equipment, real estate acquisition. And if there is one use of proceed that is more than half of the entire project, right? So 50+%, then the entire loan can assume that dominant structure. So if real estate is more than half of the project, then the real estate structure is a 25-year fully amortized loan. So then now you're buying the real estate at 25-year paper, but you're also getting the business on 25-year paper. So that gets really, really interesting. The thing is, to find a business valued, equal to or less than the real estate, that you're really working in some really interesting segments. But I guess you can even look at like, I want to serve. Here's something else you can do. You can buy a business and buy a different property at the same time. It doesn't have to be the one that's tied to the business. So that's also a misnomer. Like, let's say you want to do this 25-year thing and you want to do rent replacement because the seller is going to be really greedy and they own the real estate and they want to give you a stupid rent. You can be like, okay, I'll buy the business. The building across the street has a for sale sign. I'm more than happy to buy that, and the SBA lender can do both.
Gotcha. So do you think it's, and this is a question I never know the answer to. So I'm going to be honest about this. Do you think it's better to include that in the 7A loan, or should you get the 7A loan for business acquisition purposes and maybe get a 504 loan? I would think that it's better to include it in the 7A because you're going to get the whole amortization on the entire.
You got to do the math.
Deal.
There's some math here, Rich. Right, so I would just do
but the rates are a lot
comparison.
Lower. Yeah.
The rates are lower, right? The rates are lower. You can still go up to but here, let me counter because I'm a 7A guy. 504 guys are different than 7A guys. They're a 7A guy. But the 504 is a great product. And frankly, on 99% of the real estate use cases, I say always go 504. But on the 7A side, if the closer you get to 50% of the business acquisition to the business, like if it's at 45, right, then it just becomes a no-brainer to do, because you can get in with the 7A. It's got a 3-year prepay. You can pay up to 20% of the principal per year. You pay it down. At the end of year 3, you go back refinance into a 504.
That's
so then you get the little double debt there. You get boom. But then here's the cool thing about the 7A. I think you can go up to 100% financing on the acquisition of the real estate. I only need a 10% injection on the BizAc. So that's the other secret sauce.
Yeah. Okay. Wow, that's good inside information. I didn't know that. So
there's a lot in the gray. That's welcome to Javi's Corner. We can talk about SBA any day you want.
Well,
I left my contact information in the here. I'll copy it and drop it again. But this is my cell phone number. This is my email address, guys. If you need anything, please do not hesitate to, reach out. Were you gonna end on a note?
Well, I was going to end with thanking you for jumping on with us this week. I'm sure we'll probably have you on again sometime in the future as, of course, SOPs always change, and probably just to give a kind of a general update as to kind of where Locality is in terms of their thinking and their credit box.
Oh, I forgot, Rich. I left that nugget about the 100% LPR. I sit on the board of Nagos, so I get to hang out with like the policymakers. So there's
Yeah.
So as everyone, we'll leave on this inside stuff. 100% LPR or legal permanent resident or citizen is the requirement today. That's caused a lot of problems, guys. There's, surprise, surprise. There's a lot of intermingling between foreign-owned businesses and U.S. businesses, right? And frankly, in my mindset is I fully support a government guarantee program to support U.S.-controlled companies. But let them raise capital. Who cares, right? Raise capital from anywhere. I don't care. I'm agnostic from where. As long as it's green and it spends, I'm good. But there's a rumor that a 3 to 5% carve out is going to be considered. So we may see a special notice come out between the next iteration of the SOP that could give a little bit of wiggle room, because to allow minority partners to divest down, or to get to a piece where they don't have to get completely wiped out and stay on board. But that is a rumor. That is not anywhere on any public site or anywhere. So this is inside scoop stuff, early stuff.
So I would say for all you AEs, let's put that out there on Twitter and LinkedIn and all that, and then we'll say Javier Jorge told us about it. I'm just kidding. Anyway, thanks, Javier, for jumping on with us. I appreciate it. Appreciate your time, man. And we look forward to seeing you again next time. And I look forward to the next time I can host this call and see the rest of your beautiful faces out there in AE land. With that, I will see you guys off. And Javier, I'm sure we'll be in touch here on some
Thanks,
deals.
Javier.
Thank you, guys. Happy Monday.
Thanks, Rich.
See you guys.